Collins & Co.'s not-for-profit conference, Be Empowered Through Knowledge, is designed specifically for the not-for-profit sector. Our speakers are experts in this sector, and their practical approach provides not-for-profit board members and management with the opportunity to improve their skills and knowledge across a range of specialist topics. The conference also provides a great networking opportunity.
Brian Buckley has over 25 years experience in financial markets, banking and funds management, joining Mutual Limited in 2010. Brian was appointed to the board in 2015 and is currently head of portfolio management. Brian has experience in investing for not-for-profit and corporate sectors, along with many years experience in trading bonds. Wayne and Brian is here to discuss how an alternative to term deposits may assist your organisation. Please welcome Wayne and Brian.
Thank you, everyone. My name's Brian Buckley. I'm my business partner, Wayne, from Mutual Limited. I know I'm standing between you and lunch, so I will be as brief as I possibly can. And I just want to discuss some fixed income as an alternative to term deposits with you today. We specialise in fixed income, and we're passionate about education and delivering investments which are appropriate to the investor. We've each got 20 years experience in the markets, going through all the cycles, through the currency crashes, GFCs, bull markets, Brexit, and we aim to deliver through those cycles. Bearing in mind the allocation we're in, where principal and interest guarantees are the most important feature for our investors. So throughout the presentation, I'll refer to fixed income, bonds, floating rate notes, fixed interest. There's lots of names for the one thing, and basically anything that is a bond form or a fixed income form is very similar, and they all go by the same name. So if you've heard them with different names, that's the reason why. What I want to discuss is bank balance sheets, so the capital structure, the current TD market, how fixed income is an option, how fixed income works, fixed and floating rates, and how Mutual and Collins Co can deliver the best results for investments. This is a diagram of a bank capital structure. We all know about deposits because that's what we all invest in normally. So a term deposit at the bank, where the bank guarantees it'll pay you your interest and return your money back at maturity. The other thing most people know about is the bottom part, which is common equity, and that's shares. And you can see from that totem pole that there's a lot of different asset classes in between the two. We specialise in the blue ones, and the blue ones are direct to the balance sheet, whereby if the bank or the issuer doesn't pay your interest and doesn't pay your principal back on time, it is a default. So therefore, we've got certainty about what the outcome's going to be for the investors. If you look at the second red section, which is hybrid securities, a lot of investors now are looking at hybrids or tier 1 securities that are listed as a de facto to fixed income. We treat them as equity because the interest payments are not guaranteed and the principal coming back at maturity is not guaranteed. If everything goes well, everything's fine. But in times of stress, that's when things can go wrong with hybrids or tier 1 equity. So we typically steer clear of those because of the uncertainty and the fact that our clients, which is similar to yourselves, want that certainty when we invest. This is the problem with term deposits. The first third of that chart is what a TD was paying above the risk-free, or below in this case, the risk-free rate before GFC. So you can see there the blue line is the BBSW, which is the benchmark rate. It's just a rate that the market sets interest rates from. You can see pre-GFC, a term deposit used to receive approximately 0.1% below the benchmark. After GFC, banks wanted term deposits a lot more. There was some regulatory changes from APRA, and there was a strong competition for term deposits. And everyone, just about everyone, was buying term deposits because the spread to the risk-free went as high as 120, 130 points. And they were safe. We were going through GFC, everybody bought. What we're now seeing, though, are reducing spreads because banks want to make profits. This goes directly to their cost of funds. So therefore, the more they pay on term deposits, the less money they are going to make. And in a term deposit market, banks are price makers. They can set whatever term deposit rates they want. Now at the moment, they're around about 40 over the risk-free. The banks would love to see it under risk-free again. They're probably not going to get to there, but they are going to squeeze and squeeze and squeeze as low as they possibly can. And this is why investors should look at something other than term deposits in order to get a higher yield. This is the chart of fixed income. Again, the blue line is the benchmark. The orange line is the senior bank bonds, and the grey line are subordinated bank bonds. So when you look at the capital structure, the senior is just below deposits, and then you've got subordinated debt, which is just below the senior, however, is still an obligation of the bank. You can see there that pre-GFC, the yields were above the risk-free. During GFC, they went up also, very similar to term deposits, but we're not seeing the contraction of the spreads. And that's because the funding for this market is international, and international buyers decide what the pricing is on these bonds. So banks here are price takers. They cannot manipulate the way this funding is going to be. So therefore, it is going to be a more stable return above the benchmark and more secure as to knowing what's going to happen on the fixed income market than the term deposit market, where the price makers are trying to squeeze that spread. And that's the case for fixed income. Now, the issues people have with fixed income, and I'll address a few of them, a lot of people are under the misconception that it is fixed interest rates, probably because of the name. But most fixed income that we sell to our investors and our investors buy is actually floating rate notes. So it's floating fixed income, which means that if you buy a security for a year, you receive a margin above the 90-day bill rate every quarter. So it's more like a home loan that is variable, as opposed to a home loan that's fixed. In times like now, where most people believe interest rates are going to go up, one of the reasons we hear from people is, I don't want to buy a bond because rates may go up. That's fine. Don't buy a fixed bond. You buy a floating bond. So you get the benefit of these spreads, but you don't take a fixed interest exposure. Fixed income is an obligation of the issuer to pay regular interest payments to the investor and capital on the maturity or call date. It is an obligation that they must do it. Interest payments can be floating or fixed. The dates are usually 1 to 10 years, but there is liquidity. If I buy a bond in the marketplace today, I can sell it tomorrow. And the price I buy or sell that will be determined by the market. So for instance, if I buy a bond and the credit margin that I buy it at is 100, and then I sell it and the credit margin is still 100, I don't lose money. I receive on my income and I sell the bond to the marketplace. So I'm not paying a penalty like I would on a term deposit if I was allowed to redeem it early. Because the terms and conditions on term deposits now have all changed, and it is up to the bank to allow you to redeem a TD early. And even when that happens, it's 31 days notice. On fixed income, liquidity it can be same day if required. The normal market practice is 2 days. So it's a very liquid market. Issuers are normally governments, banks, corporate entities, special purpose vehicles. We generally concentrate on the banks and government bonds because we see them as the most secure bonds to buy. If I want to take risk, I might buy equities. I'm buying a bond because yes, I want a higher rate than what term deposits are giving me, but I want certainty. I don't want to worry about buying a corporate bond and the share price goes south and I'm wondering what's happening with my money. So I'm buying a regulated body, so either government or a regulated bank. Because whilst banks aren't the most popular organisations in the world, they are safe, and they are, and as Australians know, we like to put our money in banks because they fulfil their promises. And in this case, they pay their coupons and they give you my money back when it matures. Fixed or floating. So the coupons are usually paid every 90 days. So I could buy a bond for 3 years and every 90 days or 6 months, depending on the bond. Fixed rates is normally 6 months, floating every 90 days. I get a coupon. And then it will be either fixed or floating. So investors will choose a fixed coupon if they want certainty. You might think rates are going to go up, but you may still want certainty. So for instance, if you've got $1 million and you want to receive $40,000 a year for 5 years, one of your options is to go and buy a fixed bond at 4% because you are going to get $40,000 every year. You know, the other option is you can buy a floating bond because, hey, I think rates are going to go up. But if rates go down, you're not going to get $40,000 a year. So fixed bonds are great if you think, A, rates are going to go down, so you lock in and I've got a fixed rate, or I want certainty. Irrespective of what I think rates are going to do, because nobody really knows if rates are going to go up or down, I can buy fixed. People will buy floating rates if they think rates are going to go up, which is probably most people in this sort of environment. So most investors are buying floating rate instruments. And also it decreases risk. And by this I mean bonds you can sell back. If I've got a bond that's fixed, I've taken on board interest rate risk. So for instance, if I buy this bond for 4% and then a year into it I say, listen, I don't really want this anymore, but rates have gone up to 6%, nobody wants my bond at 4%. I'm 2% out of the money. And it might have 2 years to go. So I've lost 4%. So therefore, I've taken on board interest rate risk. If I was to sell that bond, I'm only going to get $96 for it. On a floating rate, you don't have that issue. Because you're resetting it every 90 days, irrespective of where the interest rates are, that bond is going to attract the interest rate. So therefore, when you go to sell the bond, that risk is no longer part of the equation. So a floating rate note increases your liquidity. By the same token, if you buy a fixed bond at 4% and rates go to 2%, you make a capital gain. This is a bit hard to see, but this is basically the typical fixed interest holdings. And typically, what we see is a big major bank, take the major 4 banks, you could buy a senior bond for them and get around about 3%. You could buy a subordinated bond from them and you'd get 4.25. Or you can go and buy a corporate bond, and depending on the creditworthiness, you'd get more. You can buy a government bond, which are typically fixed, and you're going to get about 2.3. But where we concentrate, which is typically the bank, you could put a portfolio together where from term deposits where you'd be getting 2.5 to 2.7, and you could put a portfolio together with bank risk, without interest rate risk, at 4 to 4.5% without too many concerns. How do you do it? Well, you buy fixed income through financial intermediaries or fund managers. And we use a system called Austraclear, and Austraclear is run by the ASX and owned by the ASX. It is like CHESS for fixed income. So it's a regulated platform. And investors need to go to a financial broker or fund manager or bank with access to this. We do the service along with Collins Co, and others also do. Where we're different from a broker or a bank selling fixed income is that we charge a fee and they don't. And believe it or not, that's a positive. Because we charge a fee, we go into a market that isn't transparent and we get the best rate for you and we pass that on to you. If someone does it for free, they're broking it, which means they go into a market that is not transparent, they buy a bond, and then they sell that bond to you at a different price. And they will not tell you what that price is. There's one way that is transparent, which I prefer to deal with. There's another way that is not transparent. And that's why our clients use us rather than a broker, because they need to know that they are paying me, so therefore I am working for them, as opposed to a broker who wants to do deals and he won't tell you what the real market is. And it's a dangerous market. I see people buy 10-year bonds. And the difference, if I buy a 10-year bond for $1 million, and if the rate should be 4.5, but the broker goes into the market and only gives you 4.3, that's 0.2%. But not for 1 year, for 10 years. That's 2%. 2% on $1 million is 20 grand that broker has just made without anybody knowing. And where the cost is, you don't pay the $20,000, so you never see it. Where the cost is that every year for 10 years, rather than getting 4.5, you're getting 4.3. And that's why at Mutual, we always deal in a transparent manner whereby we go and get the bond in the marketplace, deliver it to the client, and we've got a pre-agreed fee which the client pays us. Which is basically what I've just gone through. We give reporting, we do committee presentations, product education, policy establishment, anything to ensure that the investor is buying A, what they understand, and B, what they should be buying. That's my disclaimer, but I do stand by everything I said. Any questions? Everyone's hungry. Sounds good to me. Thank you.
Thank you, Brian.